Over the last few years, the Ftse has taken a battering, with the recent uncertainty around the Brexit vote and referendum in 2016, and the uncertainty of whether we'll leave with a soft or a hard deal has troubled UK investors. So currently, right now, the markets, at least the Ftse markets, are high value. Now, in the more recent few months, the pandemic situation has led to even more value being created in the markets. With the economy being shut down, this is a time for UK investors to look for more safer dividends to purchase for their portfolios. An example of this would be investors selling out of riskier assets and buying more safer assets like consumer staples or utilities. And with the abundance of recent dividend cuts, it's harder for investors to avoid them. So now we all look for safer investments for our portfolios. So we look towards the safer stock options to get the best return on investment. However, I'm looking for a dividend stock with high value and a high dividend with a high margin of safety. So what is a dividend? It is a sum of money that companies pay shareholders regularly for holding. And if you're interested in dividend investing yourself, click the link down below to sign up to Freetrade and get a free stock valued up to £200. Click down there, thank you. So which stock do I believe to be the best value and the safest as of April 2020? Reminder, I am merely an individual who is speculating and this does not constitute financial advice. Please use your own due diligence when investing or seek independent financial advice. So the stock with the highest FTSE 100 allocation is Royal Dutch Shell. There is a disclaimer to be had here though. There are two separate versions of it. There is RDS-A and RDS-B. The A version is for Dutch, so if you're investing in it, it's not for the best. If you're a UK investor, don't invest in it because you'll be subject to 15% withholding tax and the dividends will be paid out in euros. However, if you're Dutch, then that works for you. For UK investors, we want to use Royal Dutch Shell B. RDSB is a ticker symbol, and that is what I'm going to be explaining about in this video. With a dividend yield of 10%, most investors would question the safety of this dividend and wonder why it is such a high amount. And considering the recent oil price war between Saudi Arabia and Russia, it has also led to a downturn in this stock. High dividend yields usually indicate an unstable price, and so it is usually a red flag for investors. It is worth noting that this company has not failed to pay a single dividend since World War II. I repeat, World War II. So this company's top priority is to continue paying its dividend to shareholders. So that is why in the recent news that Shell have released 9 billion of assets and now have that in free cash flow has surged for the stock price. This is because the investors feel safer around it. This is a company that will do anything at all costs to keep the dividend going, and they've also resorted to cutting off their share buyback program. Although typically this is still a riskier option because they haven't declared their ex-dividend date yet, but this usually happens at the start of May. So for the time being, I'm confident that it will happen unless something drastic happens into the news about the pandemic. And if this dividend is declared in May, I strongly believe that they will not cut this dividend this year at all. If you've enjoyed the video so far, please consider subscribing for weekly portfolio updates on my Freetrade account and personal finance advice. Currently, Royal Dutch Shell's payout ratio is astronomically high at 96%. This means that they are paying 96% of their earnings as dividends to their shareholders, which is very risky and very high. However, it is this high because of the recent drops in oil prices, deducting from their earnings, and an already high dividend. In the future, Shell look towards reducing their payout ratio to 82% in 2023. So this is a positive look on the company, and for long-term holders, I believe this to be good. It's also worth noticing that their short-term assets also outweigh their short-term liabilities, which is good in a pinch. This means that they can liquidate if possible and therefore avoid the short-term debts and have them paid off. So it's quite a safe amount with their cash flow. And this company is well covered by their debt to equity ratio of 34.6%. Counterintuitively, I actually hope that they cut their dividend in the short term. Whilst, yes, it would seem silly that I would hope to lose money, but this would mean that the company could secure its business and therefore Rather than having extreme pressure to operate and offer the dividend, they could relax a bit, get back onto the pace and then re-announce their dividend at a later point. This way I'd be happy with the company and the way the future is going, especially with that alarming payout ratio. However, if the economy is shut for many more months, I wouldn't be surprised if most, if not all of the Ftse 300 companies do cancel their dividends. There are some that could survive this and have got high cash flows and are weathered to survive longer periods of time, but I do believe a lot of the companies, if this pandemic situation continues, will cut their dividend. So that is something to look out for. And I strongly believe this to be one of the best undervalued investments right now, with a high dividend yield. According to Simply Wall Street, the company is 70.3% undervalued, which means in the likelihood that the dividend is cut, they're still operating under a more than fair share price. They believe that this share price will rise from the current price of £14 up to £49. So it's worth looking at as well. Whilst yes, the dividend could be cancelled in the short term, as a growth stock, it could still reach that value and still potentially outperform the market and be a great hold in your portfolio. At the end of the day, it's a long-term investment with high value, and there's something that isn't going to change in the future. Unless more radical policies like the China's one-child policy happens globally, the population is going to consistently increase. And with an increased population, there's going to be more demand for energy. More people will need the energy in order to survive. So in the future, I believe that Shell's earnings will increase steadily, and I will believe that they will thrive in the current environment and the future environments, especially because they're moving to more greener offerings. Overall, as a UK dividend investor, I'm going to be buying a lot more of Shell this month, and I will continue to pound cost average into the market. And if you're interested in what I'm currently buying, click the top right of the video to see my current Freetrade portfolio, and it'll be updated weekly. I'm Osborne Foreman. Thank you for watching. Have a good night.